If your bank balance is low, if you have no investments, and you feel that everyone else is ahead, please listen carefully. Wealth is not built by waiting for the perfect moment, but by establishing a robust system. This video does not promise rapid riches. Instead, it outlines a path to financial stability followed by wealth accumulation. I will present a realistic plan designed for individuals starting with minimal resources. Adhering to this plan over the next few years will significantly transform your life. Part 1. Understand your real position. Before engaging in any investment, clarity regarding your financial standing is essential. Many individuals avoid examining their finances, remaining unaware of their spending habits or savings rates, and merely hoping for improvement. However, hope is not a viable strategy. Begin by utilizing a notebook or a notes application to record the following: your monthly income, monthly expenses, outstanding loans, and current savings. Be honest in your assessment. If your income is $20,000 and your expenses are $19,000, you are not experiencing financial hardship, but rather a lack of structure. Conversely, if your income is $20,000 and your expenses amount to $25,000, you have a significant issue that requires resolution. Wealth cannot be built amidst financial confusion. Clarity must precede all other steps. Part 2. Control spending without suffering. Extreme frugality is not necessary. Instead, controlled spending is the objective. The conventional 50-30-20 rule is often impractical for lower incomes. Therefore, I propose an alternative framework: needs, growth, and fun. For instance, with an income of $20,000, allocate $13,000 for needs, $4,000 for growth, and $3,000 for fun. The growth category encompasses saving, learning, and future investments. Track your spending daily for 30 days. After this period, you will discern spending patterns. Eliminate only those expenditures that do not enhance your life. Strive not for perfection, but for awareness. Part 3. Build your first safety fund. Prior to investing, establish a safety fund. The targets are as follows: Target 1, $10,000. Target 2, $25,000. Target 3, $50,000. The purpose of this fund is not to generate returns, but to serve as an emergency reserve. Without such a fund, unforeseen problems can derail financial progress. This money should be held in a savings account or a liquid fund. It should not be invested in stocks. Accumulate this fund slowly but consistently. Even saving $100 per day is effective. This phase may span 3 to 6 months, which is okay. Prioritize stability before pursuing growth. Part 4. Increase your income. Saving alone is a slow process. Income growth, however, is transformative. If your current earnings range from $15,000 to $25,000, concentrate on skill development. Select a marketable skill, such as video editing, graphic design, social media management, copywriting, sales, basic coding, AI tools, Excel proficiency, or financial fundamentals. Dedicate 1 hour daily to learning. Utilize free resources like YouTube, online courses, and practical projects. After 3 to 6 months, begin freelancing or seeking improved employment opportunities. The objective is to increase your income by $5,000 to $15,000 within 1 year. As your income rises, saving becomes simpler and investing accelerates. In the initial stages of wealth building, your income is your most potent tool. Part 5. Remove bad financial habits. 3 habits commonly impede financial progress: impulse buying, lifestyle inflation, and inconsistent saving. Address these proactively. Before making any non-essential purchase, implement a 48-hour waiting period. If the item remains necessary after this period, proceed with the purchase. Otherwise, forego it. Upon an increase in income,
Refrain from immediately escalating your lifestyle. Prioritize increasing savings and investments. Automate your savings. Upon receipt of your salary, save first, spend later. Part 6. Start investing the right way. Having established an emergency fund, secured a stable income, and gained control over your finances, it is now time to commence investing. Maintain simplicity in your approach. Open an investment account. Select either index funds or mutual funds. Initiate a monthly systematic investment plan. For instance, consider starting with $3,000 per month, increasing to $5,000 per month, and subsequently to $10,000 per month. Refrain from daily trading. Avoid pursuing rapid returns. Your objective should be consistent investment over several years. Invest every month. Disregard market fluctuations. Increase your investment amount as your income grows. Investing is inherently unexciting, which is precisely why it proves effective. Part 7. How much you actually need. Let us adopt a practical perspective. If you invest $5,000 monthly and gradually increase this amount each year, you will accumulate substantial capital within 10 years. Investing $10,000 monthly will yield even better results. It is not necessary to acquire large sums immediately. Rather, focus on making consistent progress. Prioritize income growth, consistent investing, and patience. Wealth accumulation is initially slow, but it subsequently accelerates. Part 8. Common mistakes to avoid. Mistake 1. Procrastinating the start of investing. Mistake 2. Engaging in trading prematurely. Mistake 3. Investing without adequate savings. Mistake 4. Discontinuing investments after only 3 months. Mistake 5. Comparing your financial journey with others. Your investment journey is a long-term endeavor. Therefore, disregard short-term market noise. Final message. If you begin today with no prior investments and adhere to this system for 5 years, your financial situation will undergo a significant transformation. This change will not occur overnight, but will unfold gradually. Track your finances, save consistently, increase your income, invest monthly, maintain patience. While this advice may not be thrilling, it is effective. 5 years from now, you will be pleased that you initiated this process. Start with a modest amount. Maintain consistency. Build wealth incrementally. Wealth is not generated by a single significant action, but numerous small, repeated actions over many years. Begin today.